years of trading experience. Rob is the president of Axiom Research and Trading Incorporated, which is a market research and trader training and mentoring firm. It specializes in futures markets and is also the parent company to oiltradingroom.com and indicatorsmart.com. Rob, thank you so much for joining us today. I know we're getting a bit of a late start, but thank you very much for being here and taking time out of your day to speak to our audience.
Yeah, thanks for having me in, Brian.
Yeah, can you tell me a bit more? I know you've got a pretty rich history with some pretty prestigious awards that you've won for trading. Can you tell us more about that?
Yes, I won the Robbins World Cup E-Mini Championship in 2008, and I came into trading. I started developing computerized trading systems in the early days before they really had software for doing that, and began developing those systems long about 1990 or so. And then I just kept doing it with a lot of passion, and ended up becoming a commodity trading advisor and ultimately the biggest E-mini S&P trader in the world at various points in time. And so it's been an exciting journey.
Yeah, it definitely sounds like it. I'm sure we'll get into this as we talk more about the aspects of your trading systems and what you trade, but I see here in your bio that you're an NLP practitioner, a coach, and a board-certified timeline therapy hypnotherapist. So I'm sure those have all played into your trading success as well.
Yeah, I'm really big on personal development, and I also believe strongly that trading is a really wonderful environment for personal development because it gives you instantaneous feedback about your emotional state and where you are. And so it's a really good trading's a good opportunity on many different levels to really advance yourself.
Absolutely. I know I've noticed that over the last 8 years or so of trading myself. I tell people all the time that I feel like trading has really opened some windows for personal growth for myself, and I'm a very different person today because of trading. Very, very different.
Yeah, it gives you a real strong dose of reality really fast.
Yes, it does. Yes, it absolutely does. Yep.
Gotta love it.
Yep. So, in your experience, what aspects make those very best trading systems? I know that you mentioned you won the World Cup trading challenge, E-mini trading challenge, and you've been developing systems since the mid-90s. So what makes the best trading system?
Well, in a nutshell, the simplest way of describing that is simple statistics. And when I say simple statistics, that's it's called Bayesian statistics. Basically, what you do, Brian, is you look at how often something happens. If you have a certain criteria, you just measure how frequently that happens as opposed to how frequently it does not. I'll just give you a real simple example. Let's say that you have a market and it's the open of the day, and so you know that market moves a certain number of points in a day. Let's say it moves $1 in a day. And so you could ask the question, if this market moves 20 cents, what's the probability that will be the direction that it's going to move to hit $1? Because you know it hits $1 every day, right? And so then you might do that stat at 25 cents, you might do it at 30, 35, 40, etc., and create what we call a probability distribution for each increment. And then from there you'll end up with a simple statistic that says, okay, if I go 40 cents, I go $1. And so, and I do that, say, 72% of the time. Well, that's an actionable statistic that's giving you something that's well better than random. So what we do is we take simple stats like that, and I just use that as a simple example because I think everybody can understand that easily. And we put them into a collection of stats. And so you might see 5 or 6 of these things lining up all at the same time, each one being independent of the others and uncorrelated to the others. And when those things line up, you end up getting an extremely high probability of meeting your goal. And that's the very best trading systems in the world are designed like that. So simply put, it's called a multi-model system, and it's made up of components of uncorrelated, simple statistical rules that lead all to the same end result.
So with modeling like that and being in the long-term statistics that are available in the marketplace, most traders still lose. Why do you think that is? What traps are they falling into that's causing them not to maybe stick to the rules that they've got with these systems?
Well, I can answer that on several different levels. One,
I'm sure you can.
yeah. One is, I just described a simple system. What traders will do is they may know very well that stat is there, but they will become impulsive and get off their what they know is right. Because most traders will tell you when they know they're doing something wrong. And they will actually sabotage themselves even though when they know the statistics line up in their favor doing something different. Now the question, of course, becomes why do they do that? And the reason that they do that is because they are expressing some kind of internal desire that is in conflict with that outcome. They might have a strong need to prove. Let's say that when you're a little kid and you're growing up, all the other kids called you a loser. I'm just making that up. But let's just imagine, because we all know we went to grade school. Kids can be pretty mean, right? And so, all the kids are doing that. And at some point or another, if that behavior continues under the right circumstance, that little kid might begin to believe that himself at some level. Not purely, of course, but he might begin to believe it at some level. And then if he has some failures as he goes down the road, he might actually begin to fully believe that. But what happens is because he learned that when he was like 6 or 7 years old, the seed for that tree got planted when he's 6 or 7 years old. He forgets. He forgets about that. And then so what happens is that develops as something that we call a limiting decision. He makes a limiting decision that he's a failure. And so when he goes into the trading world, he knows that stat says 90% in his favor, right? But the unconscious desire is to actually prove that he's right. And unfortunately, what he wants to prove is right, that he's a failure. And so he'll actually self-sabotage over and over and over again, will engage in the exact same behavior. And it's really tragic to see this kind of thing happening, Brian, because these kinds of things can usually be fixed in a relatively short period of time. But this is also why I teach trading from a statistical basis, because if you've seen that you have a 90% stat that the market's going to a certain level, and for the 47th time you sat there and didn't take the trade or took an opposing trade or something else, and you could have had a $500, $600, $700 winner, but instead you lost. After you stare that in the face so many times, that actually forces you to have to come into alignment with your limiting decision and ultimately resolve it. And so if you take the stats and you repeat them long enough, then people's belief systems will come into alignment with reality. It's really kind of cool that way.
Right. So that sounds like that's one of the biggest traps that traders fall into is not working on their own self-development and changing those core belief systems that are going to help them become successful. Yeah,
you run into this thing. We have met the enemy, and I am it.
Right.
Yeah.
Right.
Yeah.
So, inverse to that, what is one of the factors that contributes most to winning? What is that?
Well, when you are in alignment with there's a really wonderful book. I won't suggest that you read it necessarily. But basically, there's been a lot of research done in recent years that the conscious mind, the one that we're using to listen to what we're saying right now, that part of us that's listening, that mind is actually only capable of doing a couple few things at a time. They say 7 plus or minus 2 bits of information that the conscious mind is capable of handling. But the unconscious mind, that's the one that drives you all the way across town in your car and you don't even remember it. It knows how to do that. Your mind knows how to do that. Or I like sports analogies. A basketball player, doing a layup shot. There's probably 700 muscles involved in doing a layup shot. And it's extremely complicated thing that all gets chunked into one fluid piece of behavior. But if the unconscious mind is not, which is this vast reservoir of knowledge and skills, that's your conscious mind can't tell your finger to move. I think there's something like 152 muscles between your shoulder and the tip of your finger. But you can sit here and hold your finger out and say, finger move, and your finger will move. But your conscious mind can't even begin to comprehend what it takes to move your finger. So the conscious mind passes the instruction for the behavior to the unconscious mind, which does the behavior. So you kind of have like a captain of the ship is the conscious mind. And then the unconscious mind engages the behavior. And so when you get into trading, that if those two minds are in alignment, like it is when you tell your finger to move, because there's no question about it, when you tell your finger to wobble up and down, that it will do it. You know that. But when you get into more sophisticated behaviors you're operating in the realm of probability, and there are other factors and unknowns that come into play with that, then it becomes much easier for those two minds to be out of alignment. And so now this is the same topic that we were talking about a minute ago, but you're looking at it from the other side of the equation. And so to bring those minds into alignment means that what you really want and what you are doing as a behavior are the same thing. And so that's how you end up being successful. When you line that up with proper statistics and a methodology, then you can become a highly, highly successful trader when you're able to line those two things up. But it takes a lot of work to do that. But it's well worth it, as you know. Trading can be, some of the highest paid people in the world are traders, and so it's well worth the endeavor, but it's hard work. And so, the next question, I suppose, would be, are you ready to do the hard work to bring yourself into alignment and learn what you need to know in order to behave in a manner that may be entirely the opposite of how you feel at any given moment? And so that's really what's at the core of winning is alignment, right. Self-alignment, yeah.
So how did that work for you personally? How did you get, well, I shouldn't say necessarily how did you get to this level of success, but yeah, how did you, what factors have led to your ability to survive and thrive in this business for over 20 years? And that's pretty impressive, to keep growing with the business.
Yeah, I've heard people say that the average CTA or a guy in this business only lasts about 3 years. It's a tough business. I'm going to give you just a really brief kind of rundown on my history because this is interesting, and there's I think 3 things I'm going to bring up here. In the early years, as mentioned, I was a system developer. I have a degree in experimental psychology with a strong educational background in statistics, and I still use that today. Obviously, we've been talking about that, but in the early years, I operated on the premise that if I can't code it in a machine, it doesn't exist. Okay, and so I ran all my trading from an extremely mechanical standpoint, based on the system, without regard to what it felt like or what it was, what was happening, and that actually served me well in a lot of ways. But then over the years, I started developing the idea that there were things that I couldn't code, and maybe if I had a PhD in math from MIT or something, maybe I could code it, but that I started doing a lot of pattern recognition kinds of things that are small traps that traders get caught in on charts. And coding those things can be really complicated to do. And because that unconscious mind is this vast reservoir of knowledge, it can actually do things as a trader that you couldn't even begin to code probably. And so over the years, I started moving away from a really hardcore system programmer and more towards using discretion or a combination of the two. Some of my earliest development in that area would have been things like I'm operating trading systems, but I'm selecting which systems I'm trading at any given time based on what's happening in the market. And I used to call it anticipatory thinking. I'm anticipating what kind of an environment that I'm in so I can select the best system. And then I started moving towards pure discretionary trading in the intraday time frames. Now, this issue of time frame is interesting because as you get into shorter and shorter time frames, these notions that we're talking about with psychology become more and more critical. Because what happens is the ability in a shorter time horizon for you to become confused or disoriented is increasing, And so intraday traders can get into a lot of trouble if they're not really stable or have the alignment that we've been talking about. And so I started moving towards that. But like in my swing trading, where I'm trading on a multi-day basis, I'm still pretty darn mechanical with some discretion in terms of how to get the trade executed. Sometimes if we're trading quite a bit of size, I need to be careful about how we're getting a trade executed. And so to answer the question then, the things that ultimately led to me surviving over the years, because I found that in the end game, mechanical systems will always fail. And so, because they're usually based on past data and the markets are always changing, especially as the markets have moved to an international kind of influence compared to, say, what they were even 5 years ago or something like that. And so the factors that have led to me surviving is just constantly adapting on a walk-forward basis, but not walk-forward as like a walk-forward optimizer, but on a walk-forward basis with these kind of Bayesian statistics that I'm describing. And the other one is to know when your systems aren't working so that you can back your allocations down. You may still be trading, but you back your allocations down when things aren't working. And then when things are working, you line yourself up, and then what happens is you hit the mother lode every once in a while and get a really, you'll make a lot of money in a short period of time. This is another thing that traders don't understand, is that a good deal of the time when you're trading, you may just be managing risk. And so you may not be winning big or losing big. You're just kind of like hovering around there in the middle, but you're in the game. If you're not in the game and you don't go up to bat, you can't hit a home run. And so a lot of trading ends up being in the big picture. You're trading and you're trading and you're trading. Little small wins, small loses, small wins, small wins, small wins, small loser, this kind of thing. And then boom, you hit a big one. Then you go back to it. Small win, small loser, small loser, small loser, small winner. Boom, you hit a big one. And so if you can kind of if a trader can kind of wrap his head around that bigger picture, that the payoff is coming, then it makes it much more survivable. Because if you don't get in those big trades, then you end up being a net break-even trader, and that's a lot of traders get into that, where they have trouble really booking the big trades. Yeah, and that's why the example I used earlier is based on range expansion. If you can understand what kind of ranges you might be dealing with, you can know that I should really continue holding here. I need to continue holding for the mother lode trade.
Right.
It's hard to do. Emotionally it's hard to do, but that's what you got to do to be a pro and a survivor in this business.
Yeah, I think that's where the consistency comes in, is being able to stick to a plan even when you're in a flat period or a period of drawdown. Is understanding the long-term objective of it all.
Yeah, the old saying, plan your trade and trade your plan.
Right.
Yeah, that's.
And I was going to say, I think a lot of the traders get into that. You mentioned automated systems earlier, which is a really good point. A lot of traders try to eliminate the emotion and try to create a plan that can stick to by fully automating everything. But then you touch on the fact that over time, most automated systems fail. What do you think is the biggest pitfall then of the automated trading system?
Well, the problem is now. See, this is another area where I've really changed the way I approach markets. I don't backtest anything, not in a traditional sense. A lot of the software that's out there is doing back testing that's based on certain kinds of assumptions that, and I don't want, this could be like a whole book or something probably, but, it's just like the assumptions are wrong. It's almost impossible for you to not find a good parameter set on some trading system that's going to show that it would have won in the past. But the problem is it won't hold out for the future. That's why these uncorrelated statistical things, our bond model, for example, has 10 components to it, 10 totally uncorrelated components to it, and the thing is astounding. It's astounding. And like the things that we do in the oil room, you can get 5, 6, 7 things all lined up, saying the same thing. And boy, the market will really depart from those areas, because what you're really talking about ultimately is traders' belief systems lining up towards an outcome, And so, but those are the things that really come together, that if you're just doing back testing, the system's going to fail. And then what happens is, because I get the emails all the time, hey, do you have an automated system? I'm like, well, yeah, but to really trade an automated system, you've got to have nerves of steel, because the thing's going to go through periods where it's just doing stuff really dumb. It's just not going to make any sense. And most traders can't stick with an automated system. And then that comes back to the same issue that we're talking about, is having alignment. And, as a CTA of many, many years, I know that, this sounds kind of funny, but, if we're having a period of drawdown on our system that we're trading, and the broker calls me and tells me that, if I'm having a conversation with him and he tells me there's been quite a few account closings, that I know that will almost invariably perfectly time with the recovery of the drawdown. And so what I've learned over the years is that when the clients are bailing at the highest rate is the exact time that you should get in. Why? Because traders will do the exact opposite of what they need to do to be successful most of the time. Because it's the herd mentality. We can't help it. We're wired that way. And so you're feeling the same thing that everybody else out there is feeling, and so you need to do the opposite of what you're feeling. Otherwise, you're just going to be the herd.
Right.
Now that's hard. that's a tough pill to swallow right there. But you get into this thing with automated trading systems that they'll fail at some point, and then you have to go through the neurotic experience of watching them fail and wondering whether or not you should. It's damned if you do, damned if you don't. Is
right.
And that's not fun for anybody. And so I much prefer this alignment of statistically valid points that line up, and things are in your favor that way, because you're doing measures of things that have some basis in tangible reality. Like if it goes 20, does it go 100? If it goes 25, is it going to go 100? These kinds of things, and finding the point where you can kind of get an edge, a manageable edge, because the edges are there, as opposed to something that just took the data series, and if the stochastic was below 20 or something, you started looking for a buy. Well, guess what? It can just keep going down. So you'll buy it, stop out, buy it, stop out, buy it, stop out, buy it, stop out, and then, But like when you're doing pattern recognition and statistics, that you know that a trend can just keep on going. And so what happens is in those environments that your system entirely adapts to what's happening on the chart, because of the kinds of statistics that I'm talking about. And so that's the problem.
Is that kind of, I have in my notes a trading system footprint. Is that what you kind of mean then by trading system footprint, is understanding a larger picture of how the systems align and how that alignment comes into play?
Yeah, and also the thing I mentioned a couple minutes ago, getting caught in big trades, that's a system footprint is when you actually get caught in the tails of the distribution, or to put it in layman's terms, you just get caught in big trades.
Oh, I see.
But that distribution will have a certain shape to it, and you can actually determine if a system is failing or not. If often the shape of the curve will change well before the system starts failing. If you want to learn a little bit more about that, if our listeners want to learn a little bit more about that, go to my old blog. I don't really write a lot on there anymore, but there's a lot of great articles on there, markettradersjournal.com, and search on the word footprint. And there's a couple of really good articles there for you, and video and visuals for you to see on this topic of footprint, and how to make one and things like that. Yeah, that's a really neat concept about how you can kind of understand where you are as the shape of the distribution curve. But any trader knows. I mean, if you're normally trading at like 80% winners, and suddenly you're banging 40, you got a pretty good idea that something's wrong, right?
Yeah, something's wrong.
Yeah. And so, but what'll happen is the shape of that curve will start shifting. So it's just a mathematical representation of what you might be experiencing as a trader. But when you're using a mechanical system, that becomes important because you don't feel those things like you do if you're a discretionary intraday trader using the kinds of stats that we're talking about or something like that. And so, but it's very instructive to learn how the footprint works, and just the simple idea of just getting caught in big trades and how important that is.
Yeah, absolutely.
Yeah.
So what is that most basic structure in the markets movement, and how would you best go about exploiting that?
I actually, a thing that happened quite a few years ago that I did, it was a kind of a complicated coding project, but I hired a really whiz programmer to code basically what I'd call wave counts, just A, B, C, D kinds of structures of price movement. And so because a trending market will just go A, B, C, D, E, F, just wave counting. You start A at the bottom and you come up a leg, B, come down as C, go out to a new high as D, etc. Just repeat. Now, certain kinds of patterns happen within the structure where prior structures are violated or something like that. But here's what I did that really kind of blew my mind. When I laid that out into a statistical distribution, how often do you go to the D count, for example? Or how often do you go to the F count? This kind of thing. And then look at that on either side of the market. What I found was that it's an absolutely perfect statistical distribution. It's a perfect statistical distribution. It's like Market Profile couldn't make any such claim to anything like that, and it's actually trying to lay a statistical distribution onto price action. But this particular way of looking at market structure has a perfect statistical distribution on either side of the mean, and so it gives you a tremendous amount of information and edge about the way markets actually move and the structures that drive them. And so you can actually start telling what's the probability in an uptrend that a prior low will be taken out. You actually can know that's actually knowable. And so when you're entering into a trade, you can know the probability that it's going to move in your direction or not just based on this structure and where you are in the structure. And you can do this kind of distribution in a really mechanical kind of way. There's a book written a number of years ago by Art Merrill, I think. I have an original copy signed by him, which is kind of cool. I apologize, I'm drawing a blank, but you can look up Art Merrill. It's a book about wave structure in markets. That's kind of cool. But anyways, it shows all the different wave patterns that you could have, little squiggly patterns in there, and you start learning those patterns and then applying them to your trading. That's a lot of what we do. And so that most basic structure in any market is the simple ABCD. The market will generally won't go one leg and move sideways. It'll want to go one more leg and test out a high. And so you get a probability structure within this ABCD kind of wave structure. You could reduce that down into things like Elliott wave or something like that, but I approach it from a statistical standpoint with rigorous kinds of testing. And so that is the basic structure of market movement. And the best way to exploit it is to understand the probabilities associated with it. And that's what we do in the oil trading room every day. That exact.
Now, how far back do you have to go for things to be statistically relevant? I mean, you need a pretty large sample size in order for it to make sense, right?
Yeah, when I first ran those tests, I mean, I didn't believe it, because as a scientist or a statistician, the first thing that I do, I mean, if I get a result that's like perfectly balanced like that, I'm like, no way. That's the first thing you got to be able to do as a trader. No way. It's a really important program in your brain. But I tested that over years of data on all different time frames, and found it to be utterly consistent. And so, once you do that, and then you start, because at that point I'd never operated on it in an environment where I was acting with it intuitively, like inside of the market structure of the day. But then what's happened is that was years ago that I did those tests, and now, I've been doing it for so long that this, I've called it this over the years, and maybe people didn't understand it, or they were, didn't believe what I was really saying. But what happens is this kind of turns into a language. It's a language of pictures. It's because some languages are in it's like pictograms, Asian languages using pictograms or something like that to be a symbol for a concept or a word. Well, it's the same thing with shapes and waves inside of the market structure. So you have a certain shape, and that shape starts taking on a meaning with respect to the probability that's associated with it. And then what happens is, after a while, you start thinking in that language. And I know that sounds all really sophisticated and everything, but it's actually pretty simple once you start getting it under your belt, because it's just ABCD at its most basic structure. And then you can take any one of those and try to understand them from the viewpoint of ABCD. In other words, it could go ABCDEF, and I just take the new two waves of it and call that ABCD, because the same kinds of probabilities can exist on both waves. And these kinds of things. So that's the basic structure. And like I said, after you do it for a while, all kinds of different patterns will start revealing themselves to you within that structure. And then what's even cooler, Brian, is you start looking at order flow and how order flow is influencing that wave structure. And then it just starts opening up a whole world for you. It's really, really cool. I just love it.
Yeah, very good. So, in thinking that through now, and talking about the wave structures, and we're obviously looking for a trend, or maybe we're looking for a trend reversal. So, are there benefits of trend trading or counter trend trading, or is it a hybrid trading strategy? And what percentages are associated with each of those? What's the best way to go?
Oh, that's a great question. Okay. basically each kind of trading system, like if you show me like if you coded up something in TradeStation or NinjaTrader and you were back testing it or something, and you handed me the summary, the strategy summary, and I looked at it, the first number I'd look at is a winning percentage. And then I would also look at how big the average winner was to the average loser. Those two numbers can tell you what kind of a system it is. And so, in general. Now, trend systems, let's take the world-famous turtle system, for example. It's the basic rule of something like that might be, buy the highest high the last 20 periods, sell the lowest low the last 20 periods. If you do that on a portfolio of assets, let's say you're doing it in commodities, what's going to happen is, because of the structure of that system, you're guaranteed to get caught in every big trend that happens. Okay? The problem is, because you're buying the highest high of the last 20 days and the lowest low of the last 20 days, you're going to have a lot of losers. Because it's going to go tag that 20 period high or 20-day high, whatever it is, and it's going to come back down into range, and it's going to flop around, and it's going to reverse, and it's going to drive you crazy, right? So that's why they trade that stuff in a portfolio, and then once a year in a couple of different commodities or something. For example, I mean, you could do this on stocks. You could do it on, you could have a really good time doing a system like that on, high dividend asset classes, things that, real estate investment trust, utilities, junk bonds, stuff like that. But but what's going to happen is, anytime one of those markets in your portfolio gets caught in a big trend, you're going to win based on that. And that kind of smooths out the low win percentage associated with a pure trend kind of system. Okay. And just a simplistic one that works, by the way. It might return 12% a year with 24% drawdowns or something like that, but it's a net winning system in the end game. The next kind of a system, a counter trend system, will have a high win percent. Typically, because what you're doing there is, we had this example earlier. If the market goes 20 ticks, what's the probability that it goes 100? Well, you start inverting that for a counter trend system. You'd say, well, if the market goes 80 ticks, what's the probability it goes the other way? We've got all kinds of stats for this kind of stuff that in what we do. And so you can find situations with a counter trend trade where the risk is really low to enter countering, as long as you're not trading into a really strong trend or something like that. You got to be careful about that stuff. But so if they hand me the system summary and the win percentage is really high, but the average winner is small, relatively small, compared to the average win is relatively small compared to the losers, then I know that that's probably a counter trend type of a system. On the trend system, the winners are going to be big compared to the losers, because you're going to get caught in these gargantuan trades that you hold for 6 months or something, just using that as an example. So those are the two basic kinds of systems, trend and counter trend. Either you're going against the trend with relatively good probability, or you're going with the trend with a little lower probability. Both systems could end up netting out the same kind of end result, potentially. But then you get into concepts like a hybrid system, where essentially what you're doing is you have a trend, but you might try to get into the trades with the trend at the points that the market's representing it's going the other way. That would be either buying a pullback on in an upward trending market, for example. That's an example of a hybrid system. Now, if the market was on its way to 100 ticks for today, and you had gone up to 60, and then traded back down to 40, and then it started coming back up again, you might be able to get yourself in a 60-tick trade. But if you were trading pure breakout, you wouldn't get into that trade until it had gone back to breakout above that 60 ticks, right? So you actually might be able to get into the trade at about 45 ticks instead of 60 and increase the potential for your profit a bit of going to 100 ticks to 55 ticks, 45, as opposed to only 40 ticks for the breakout system. And so you end up buying the dip and then trying to ride it out to 100, and you net 15 cents more than you would have on the breakout system. We call that a hybrid system. And if you are doing good design and you're using the kind of statistics that we're talking about, you can get the win percent on a hybrid system up into the 80s and still have your win percentage be substantially higher than the losers. The winners are bigger than the losers, and the win percentage is high. That's the ultimate kind of a system that you really have, because the markets either just go up or down, right? And they might go sideways inside the range, like on the turtle system. It can come back down, come back into the range after it breaks out. But that hybrid system where you're entering on a dip, or I like better yet when it enters on a trap, it actually takes out the prior swing, luring. We're talking a long trade here, but it actually comes down and breaks a prior swing, leading a whole bunch of shorts to enter the market. And then what happens is when you enter going long, when it starts coming back up the other way, all of their stop loss orders will carry your trade higher. And so in a strategy like that, you're actually doing the opposite of what the majority is doing. And you're using these market structures with the probabilities associated with them. And then if you get down, if you're in the intraday frame, the order flow associated with it can tell you that there's net buying occurring, or that there's large accumulation within that swing to the upside. And then, you compute your probabilities and you take a stab for getting that into that $1 trade, 40 ticks off the low or 45 ticks off the low, something like that. And so that's what we call a hybrid. But you can actually tell what that system is by looking at the strategy report if it was an automated kind of a system. And you can also tell what it looks like by looking at the footprint. So if our listeners are going to go look at that footprint article, that will kind of plug that kind of thinking into that when you take a look at that footprint / distribution. Yeah, it's kind of cool. Awesome question. Thank you.
Yeah, good, man. And just once again, real quickly, to find that footprint information, they can go to markettradersjournal.com, which is your old blog you mentioned, and
right.
Do a search for footprint.
Yeah, you'll have to.
How would they connect with you for current training? We've hit really, 30,000 foot overview of a lot of things. There's most of these topics that we've touched on are so much more in depth. We've just scratched the surface.
Oh yeah. This could be a 3-hour interview, no problem. So, but go to the best way to reach me or to get an idea of some of these things that we're doing. If some of these things you connect with some of them and it seems to make sense to you, the kind of things that I'm saying, and whether it be the psychological factors or trading or just bringing it all together and getting alignment, all these kinds of issues are things. I'm 2 hours in the oil trading room every day at oiltradingroom.com every morning, and there's some really good training materials there, and I'm there to help. And there are a lot of world-class traders in that room. I mean, some really world-class traders. I've learned a lot from guys that are in the room and vice versa. It's a really good sharing environment. And so come on in and check it out. There's a tremendous opportunity going on there if you're willing to go through the materials and buckle down and learn it. Yeah, it's a really awesome opportunity. Not only for just trading, it's called oiltradingroom.com, but the principles in there apply to any market. We just use crude because crude really moves, and it really kicks up the learning curve because it's accelerated. And so you can learn more in trading in crude oil, probably at about 4 times the rate of any other market. The kinds of principles that we're learning, due to the number of alternations and patterns that are setting up every day in crude oil, the learning curve is just highly accelerated, and so that's why we use that instrument. It's a really good opportunity for learning, though. So come on in and say hi.
Okay, great. So that's the oil, actually not the, it's oiltradingroom.com. So www.oiltradingroom.com to learn more about that and sign up. You can just go right to the very top of the website. You can put in your email address and then click on Get Access for more information there.
Yeah, you can sign up there. You'll get notifications there about things that we're doing, and then you can get involved in the room and in the training materials. There's an interview series there that another trader has been interviewing me in recent weeks on the blog there that you might also find of value, and other materials on the blog that you might enjoy. So yeah, go over and check it out, man. Yeah,
there's a lot of great information. Just right on the first hit. There's a lot of information that will help our listeners go in immediately and start gathering trading ideas and trading information that's going to help them be successful. But of course, to get the most out of it, register at the top of that page at oiltradingroom.com. Great. Well, hey, Rob, thank you so much for taking some time out of your day. I know that there's a lot of things going on for you, and as an active trader, sometimes it's tough to get away. And I really do appreciate you taking time out to speak to our listeners and provide some of the insights that you've had over your 20 years of experience.
Yeah, Brian, it's been a pleasure, and thanks for having me, man.
All right, thank you very much.
All right.
See you soon.
Take care. Bye-bye.
All right, bye.
This session is no